Okay, good afternoon, everybody. It's Friday afternoon, and hopefully after this, after the weekend, and we go to the weekend, we always have these social functions, be it a braai or whatever you do over weekends. We have two stereotypes. Well, there's one stereotype, two people, and it's always two guys. And the one will say, I've got this new investment that's doing so well. And the other one will say, well, bro, you got to deal me in. And sorry, they always call each other bro and dude, so let's call them that. Deal me in. How do you deal me in? And you say, no, you got to do this and you got to do that. And then, well, one of us come in and say, but does someone tell you about Bitcoin? What happens here is that the second guy always has the struggle to get into whatever investment it is. It's difficult to do. It's difficult to open an equities trading account. At the same time, it's ridiculously easy to open a Binance account, but not everybody does that. So what do we do, and what do these folks do when they want to get into traditional investments and now also crypto? Topic of today is exchange-traded funds. It makes it easy for everybody to do this, whether it's gold, whether it's commodities, whether it's equities, and now whether it's crypto. So exchange-traded funds, what are they and what do they mean for us? Let's start with what they are. This is a bit wordy, bear with me, but it's a type of investment fund and an exchange-traded product. This is the key. So it's traded on a stock exchange or stock exchanges across the world, and South Africa's got a couple of these as well. Basically, it enables you to get access to the asset, have a right to the asset, but you don't own the asset directly. That's very different to crypto. We always say, not your keys, not your crypto. This is different, but you get exposure to the asset. So it depends on what's important for you. If you're someone who reckons that it's, not your keys, your crypto, you lose your keys, you lose your crypto, if that's a dilemma for you, this could be something for you. But that's the important bit. So it holds assets such as stocks, commodities, or bonds. And they generally operate within an arbitrage mechanism, which means that if the subscribers or the users of these ETFs sell their stake in the ETF today, the ETF needs to sell the equivalent of the commodity or entity the next day. There is a lag. It sometimes happens the same day, but often the next day. So that's also important to happen. The net asset value of those always need to balance. Otherwise, they are out of money or out of pocket. Key features. So liquidity is the one thing. You can trade them on any major stock exchange. The custody of this is basically outsourced to whoever underwrites the ETF. This is an important bit. So if you don't want to hold gold, you don't want to hold Bitcoin, you basically outsource that custody to a third party. And this is, for me, this is probably the most attractive of all of them. We then look at the costs. It's actually very cost efficient. Most of them are way under 1%, where I think they should be. It's not the most difficult instrument to administrate, so it makes sense that it's that low. But yeah, closer to 0.5%, and you'll see when we get to the Ethereum ETFs, they're actually much lower than that even. So what is the difference? And sorry, I don't know why this is blue. It was yellow when I put it forward, so apologies for that. But let's look at the difference between the BTC ETFs and holding Bitcoin directly. I'm going to start with the ETFs. So we already covered the indirect ownership of it. There's this delayed access. I talked about the arbitrage, but the delayed access and exit. It's not a big delay. It's a day or so, but things can move in that day. And then the big bit that I talk about, you've basically outsourced your collateral and security risk to the custodian. Bitcoin, on the other hand, you own it directly. If you hold Bitcoin on an exchange, you have your own wallet, you own it directly. If you have it in cold storage or on a DEX or wherever in a wallet, as long as you got your keys, you got your crypto. We all know crypto natives selling Bitcoin, I say immediate liquidity, it's 10 minutes. But you've got 10 minutes on this side, and you've got a day on this side. So big difference there as well. And basically getting whatever you traded for directly back. And then collateral and security risk, it's a bit of a nuance there. If you're on an exchange like Binance, we obviously hold that we your collateral provider, or not your collateral provider, your security provider, we do the custody for you. If you have a cold wallet or a decentralized wallet, then obviously do your homework, make sure you know who you're dealing with, but it's not outsourced. That's basically on you. Apologies, this takes a moment. There we go. So evolution of spot Bitcoin ETFs. This goes back to the 90s, and bless the Canadians, they were the first with this. They were the first two bros and dudes who had the conversation. And they had something called the Toronto Index Participation Series, which basically gave you a basket of shares. So for every 1,000 Canadian dollars you put in there, for instance, you then get a pro rata exposure to the 35 largest shares on the Toronto Stock Exchange. Let's fast forward to 2002. This was a big moment when the first gold ETF came out. And I'm going to talk about gold a couple of times. But what it does is, gold is difficult. We live in South Africa. We've got Krugerrands. If you have a Krugerrand, it's somewhere in a safe, either in your home or you outsource that to a bank. Again, it's risky because whoever holds the Krugerrand is the owner of the Krugerrand. This solves that problem where they will hold gold in custody somewhere. You just buy a ticket to the ETF itself. We now fast forward to 2021. I apologize, I should say 2024. Oh no, sorry, that's right. I'm thinking about the Americans. In 2021, the first BTC ETF was listed on the Toronto Stock Exchange. But for the purpose of this, most of the funds I'm going to cover was obviously the ones listed in the US under SEC rules in 2024. But the first Bitcoin ETF was in 2021. So going back to those US ETFs, because they're the ones who, I think this has been one of the big themes for us this year, what's going to drive the Bitcoin price? If we look back now, and I've got a couple of slides on that, this really drove the Bitcoin price, and we'll see how much it did. We'll also compare it to some of these other investments. So who are they? Since the beginning of the year, these were the players. So I've listed a couple of them there. By the way, I'm using Invest Answers on YouTube as my source. I'm a Patreon subscriber, and I think James has got absolutely brilliant material when it comes to this type of stuff. The two big ones that dominated, you can clearly see on there, is BlackRock and Fidelity. The reason for that is they've got massive customer bases in the US, and a lot of traditional finance folks use them for their investments, and I've also started using them for Bitcoin ETFs. Some of the other smaller funds, I think ARK Invest is one of the ones I followed quite closely. I think Kathy is a visionary. I think she's predicted a lot of stuff accurately. On the right-hand side, there's two. There's a GBTC. That's not actually empty. It's actually negative, but I'll get to that in the next slide. And there's one called Mr. 100. Now, why James put this on the slide was that this is an unidentified large customer that at some stage bought Bitcoin, 100 Bitcoin every day. Some days they bought 400, 500. Question you got to ask yourself is, who's got that type of money? It's either a sovereign nation, it's a big sovereign wealth fund, or it is a very big private individual. Right, moving on. Grayscale. I talked about Grayscale on the previous slide. So who are they, and why do we mention them separately? Grayscale was formed as a closed investment trust, not an ETF, closed investment trust in 2013. A lot of folks invested in it. I don't need to tell you where the Bitcoin price was in 2013 versus today. But then, I'm not sure of the technicalities of it, but the SEC locked it up. You could not exit it at that stage. But they were one of the funds that got an ETF license from the SEC and could now exit it. What happens is, day one, a lot of people made a lot of money just by holding Bitcoin, and a lot of them exited. So you'll see on this graph what happened is, that's the exit. So $650 million on the worst day, and I think if you go between day 40 and 50, almost the same amount. But a consistent exit, because again, a lot of people want to realize their liquidity events. As the fund drained, that got better and better, and I think towards day 70, you had about 140 million. The reason I say this is you need to weigh this against the purchases made by predominantly BlackRock and Fidelity. It was still net positive, but this was a big drain on it. But at some stage, this ends. What these guys did, they charged a fee of 1%. Now, if you look at what 1% is of, well, 640 million per day, that stacks up pretty quickly. The others were all at either 0.25 was the most expensive one, I think, or the average was 0.1%. A lot of them waived their fees for the first year just to get people into the instrument. Let's look at how effective an ETF is. I'm using gold here because it's a difficult to carry asset. It's a better asset. You can walk around with a Krugerrand. I don't think it's a smart thing to do, but it's still a better asset. So it's ideal for an ETF. So what happens, you can see on that gray bar, that's when the gold ETF launched in November 2004. You can see what happened to the price and what continued to happen to the price. It just becomes, it drives demand because custody is now solved. And apologies, this is blue again, it should be yellow. But I'm now looking at three things. I'm looking at gold, I'm looking at the S&P 500, and I'm looking at Bitcoin. What happened since the beginning of the year, like for like, when the Bitcoin, US Bitcoin ETF started, versus the two comps I've got being gold and the S&P 500. Gold hasn't had a bad year. 27% any other year, I'll think about it. I think I'll take it if I know you get 27%, especially if it compounds year over year. Just by the way, I think it's just under 25%. If you compound your money 25% every year, Richard spoke very well about the power of compounded interest. That magic number is 25% a year. If you can get 3 years of 25%, you double your money because it's 25 on 25 on 25. So if gold can keep this up, you basically got to more than double your money in 3 years' time. This was gold. Let's have a look at the S&P 500. Slightly worse off, 22%. But if you think about the fact that we at the top of an interest rate cycle, we've just had our first cut in the US Fed. South Africa's just had our first cut. Long may that last. That's actually not bad going. I think this can only go up as money supplies, or the tightening of money supply eases. So what did Bitcoin do? There we go, 48%. Now, we've all been speaking about October, and it's been sideways, despite the fact that it's been sideways, despite the fact that big red candle you see towards the right there, that was the Central Bank of Japan and the infamous, them increasing the interest rates and the infamous Japanese carry trade falling apart. If you haven't heard about that, Google, it's very interesting. It's an easy way to finance getting money on the one side, investing at a higher yield. Despite all of that, we're still up 48% this year. So a lot of people say a lot about Bitcoin. Is it this? Is it that? I think that's a great number. I think a lot of us have high expectations for the next year coming. We all know it's cyclical. I think post-25 we may see something different. But on a like-for-like basis, since the inception of the US ETFs, it's a big delta to the other comps. Okay, other ETFs. We talked a lot about Bitcoin. What about Ethereum? What about Solana? Now, we have an Ethereum ETF, so it's very small on the screen, but this is just to give you an idea of these, what I'm counting, 80 at least, and you can also see the fees. The fees are very low, and the highest one there is 0.25%. I mean, if you can get charged 0.25% in your bank account, that'll be great for a fee. So super effective, but not as popular as the Bitcoin ETFs. If you look at the numbers, there was a couple of days now when there was zero flows in and out of the Ethereum ETFs. So not as popular, but nevertheless, the option is there for the Ethereum axis. Other countries, I spoke about Canada in the beginning. I spoke about the US and what they've done since the beginning of the year, but there's a lot of action in other countries. Again, Brazil, they've had it for quite a while. I've just mentioned one example there being the QR Capital Bitcoin ETF. And then also the Hashdex, the Nasdaq Crypto Index ETF. Germany's got an ETP, they call it an exchange traded product. A couple of examples there. Noteworthy though, you've got someone like Van Eck, who's actually an American firm, but also operating in Germany, offering these instruments, so that also goes cross-border. Then the last three examples, Switzerland, I think they've actually had it for a while as well. They've got ETPs as well. And Australia has also had a couple of ETFs. Their biggest one called the Cosmos Purpose Bitcoin Access ETF. Singapore, very progressive nation on many fronts. They've got a Bitcoin physical fund. Now, what I need to go look at is whether that's actually something where you stake your Bitcoin. The one that's not on here, and I apologize for that, is Hong Kong. Hong Kong has got their own ETF program as well, where you physically deliver your Bitcoin into the ETF. This is different than the US, where you give cash to your financial platform and they then exchange it into Bitcoin. In Hong Kong, you can actually vend your Bitcoin into the ETF, which I think is quite good as well if you want to release yourself off the custody burden. Where does this leave South Africa? So at the moment, we have got ETFs, but we don't have a Bitcoin ETF. I think it's time for us to look at that. But in order to get that done, what needs to happen? So we've got a number of large asset managers that I think are in ideal positions to do this. There are basically four things you need to look at. So there's the Collective Investment Schemes Control Act. The JSE listing requirements, why? Because remember, it's an exchange-traded product, so this needs to go into the JSE, and it needs to form part of the JSE Act. Then the FSCA, as well as governed by the FACE Act. And lastly, the South African Reserve Bank. I think a very important component of this is exchange control. We all need to stay cognizant of that, but they'll be a big role player in the regulation of a Bitcoin ETF. What does it mean for us? And I think to the title of the address itself, what does it mean for us as crypto natives? What does it mean for us as people who hold Bitcoin? Are these guys going to crowd us out? Are they going to move everybody out of the industry and make it like a stock exchange? I don't think so. I think there's a lot of room left for people who want to hold crypto in a cold wallet, hold it on a centralized exchange, hold it on a decentralized exchange. I think this should be encouraged. The reason for that is it makes the circle bigger. A bigger circle means more demand. If you look at the adoption curve of technology and Metcalfe's law, you need more people to come into it. But you need people to come from all walks of life. You need people from the traditional finance space. You need folks who's almost going on pension. Across the age spectrum, across the demographic spectrum, and across the ownership spectrum, you need people to come in. And I think ETFs unlocks a big part of this. So I think this should be encouraged. I think if we can look at the traditional investment space, and you can get folks from that space to make a small allocation. Their financial advisors start telling them, put 2% in, put 5% in, dip your toe in the water, do your research, see how it goes. Put 5% in, and after a while, Bitcoin does what Bitcoin does. People say, hang on, maybe 5% is a little, let's go 5%. Well, I always say the spectrum is anything from 5% to Michael Saylor, who's absolutely into everything. So this will also create a growing awareness among these folks who previously wouldn't look at this. Now the financial advisor going to start saying to them, look into this, okay, but do you have anything for us to educate ourselves on? Yes, there's a lot of material out there. I always point everybody to our Academy website, academy.binance.com. People educate themselves and they grow more and more afraid with this, and this just creates more awareness, and each one tell one, especially if it starts doing really well. And it creates the opportunity for us crypto natives to demonstrate the use case of other blockchain projects. So the BNB space, the BNB chain, Solana, Ethereum, etc. People will then start looking, well, if Bitcoin is doing well, what can I get out of others? So I think that's something we should keep in mind as well. So folks, that brings me to the end of it. Thank you. I hope our time allocation has caught up a bit. I don't think that was 20 minutes, but thank you for your time. I'm around and look forward to seeing all of you.